Hi, in this video, I'm going to show you how market risk and business cycles, they are closely related and they give you the same message. First of all, let's see what the trend of the market is. And when I talk about the trend of the market, I don't look at this green thing that is sort of noise around a main trend. I look at the trend of the blue line. Look at the blue line. And when the blue line is rising, the trend is up. I know this seems obvious, but because you're now concentrating on the blue line. The problem is when the blue line stops rising or stops rising, then you know we have a problem. What's happening now? The blue line is still rising. So we have to give the benefit of the doubt to the trend. The trend is up. But the issue is, how is risk? Is risk high or low in the stock market right now? This chart shows the stock market, the green line, and the blue line, which is the 200-day moving average, and right now, as we said, is going up. But the issue is risk, and this is where I relate the business cycle to market risk. This is a proprietary indicator that measures every day, in fact every second if you wish, the trend of the business cycle. And when this green and blue line rise, the economy is strengthening, and when the blue and green line decline, the economy is weakening. Now, it's not a surprise to you to see that when the business cycle slows down, like in this period, in this period, and in this period, the economy, since it slows down, there is a slowdown in earnings per share. And of course, the market discounts this slowdown, and the market doesn't perform as well. That's why when you have these peaks in the business cycle, like here, like here, like here, and like here, you see a period of poor performance in the stock market. When is the business cycle favorable to a stock, rising stock prices? When the economy strengthens, and strengthens. So you can see that the market always went up when the business cycle indicator moves up and moves up. Right now is declining, so it says be careful because probably a defensive strategy is more appropriate than an aggressive growth-oriented selection of asset classes. So this is the message, the risk message of the business cycle. This chart shows again the stock market, the green line, and its 200-day moving average. As we said, the blue line is rising, so the main trend is still up. However, the business cycle says a defensive strategy would be more appropriate, which means, let's say, being heavier in utilities, real estate, and staples. Now, in the bottom side, the bottom of this chart, this indicator is not a fundamental indicator. It doesn't reflect the economy. It reflects what's happening inside the stock market, how people buy and sell, and what kind of things they buy and sell, and how they feel about the market. What is interesting is that when this is very useful to determine the direction of the market, of course. The thing is that when the indicator declines, like in this case, or like in this case, or like in this case, the market goes up. Here is declining, the market goes up. Here stops rising and declines, and the market goes up. The time to be careful is when this indicator rises and eventually goes above zero. When the market rises and eventually goes above zero, and when it rises and eventually goes above zero. So how do you use this indicator? That when it starts rising, it says, look, risk is going up, so be careful. When it goes above zero, be very, very careful. Like in this case, and in this case, and in this case. When instead the indicator declines, then is the time to become more aggressive. So what is happening now? Right now is happening that the indicator is rising, like you see has been rising here, and there was this decline, and it went above zero. So the problem, what this gauge is saying, that the investors, the way they are operating, buying and selling, and what kind of things they're buying and selling, are saying, look, risk is rising, but now it's above zero, and when it goes above zero, risk is pretty high, like here. So this internal indicator that measure internal workings of the market is saying risk is rising and it's pretty high. Be careful. I find this chart particularly fascinating. Relates the two risk graphs that I discussed in the previous slides. The one above here is the business cycle as we calculated in real time. This one is instead a technical indicator based for internal data of the market. What is fascinating, how the two gauges are absolutely similar. When the economy strengthens, of course, risk declines, and of course the market is strong because the market expects higher, stronger growth in earnings. When the economy starts weakening, risk increases. Here, risk increases and the economy weakens. Then what happens here? The economy strengthens and risk declines again. Then at that point, the economy weakens again, and again risk increases because the lower expectation for profits. Here the economy strengthens and risk decreases. Here the economy weakens, and sure enough, risk is increasing right now. What I think is particularly fascinating is that the investor's knowledge of what's happening leads a little bit the business cycle. What I'm saying is the risk is increasing. Investors know that something is happening, and this curve lags a little bit this rise. So this is rising and this a little bit later. Then this declines, the expectation of lower risk because the economy strengthens, and then the economy strengthens afterwards. In other words, the investors know how to anticipate the business cycle. This is, I think, I've been studying business cycles. I wrote a book that was commissioned by McGraw-Hill, and I find this relationship very, very interesting. But the bottom line is that both gauges, the internal, the technical curve, and the fundamentals are telling the same story. The economy is slowing down. A more defensive strategy is appropriate since early 2018, and risk has been increases, now is above the zero line, which makes it particularly a signal that it may be serious dangers ahead. But again, the message of this presentation is it looks like the data is saying the market is up, the trend is up. However, risk has been increasing, and so a defensive strategy is more appropriate than a pro-growth investment strategy. As you know, I'm the editor of the Peter Dack portfolio since 1977, and I discuss in detail these gauges and what is the appropriate portfolio to tackle the rising or declining risk. I also wrote 3 books, Profiting Bull or Bear Market, which looks in detail, extreme details, the workings of the business cycles, and these 2 other books show specific portfolios that seem to have performed extremely well. Again, thank you for reviewing this video with me, and I just want to remind you that all the previous videos, all of them, of course, they're free of charge. They're strictly educational. They can be reviewed on the homepage of my service, which is www.peterdack.com. Again, you don't need to subscribe. There on the homepage, and you can click on the videos that you're most interested in. Again, thank you very much, and I really hope to seeing you really, really soon. So long.